Hey, all right. So we'll get started with today's session. As requested by everyone, I have moved the class timing from 9 a.m. to 11 a.m. So it will be a 2 hours class, and we'll take a 10 minutes break in between, 5 to 10 minutes break. All right. So let's carry on with what we had started in the last class. So if you recollect, in the last class, we had spoken about the transactions where either the gain was excluded or the gain was uh, deferred. And in certain transactions, losses were deferred. Okay. So we will continue with few more transactions where you will see that there is a deferral of gain or there is an exclusion of gain. All right. So the next topic that we are going to do today is installment sale. So installment sale, uh, this is applicable for a non-merchant or a non-dealer. Okay, so basically who's not in the regular business of installment sale. So under this installment sale, you will see that you will recognize profit or you will recognize gain depending upon the installment amount that you are receiving. Usually what happens, let's say that you sold a refrigerator for $10,000 and your cost for the refrigerator was $8,000. So you have a profit of $2,000. Ideally, you should be paying taxes on the $2,000, right? But there is a possibility that, the person who's bought the refrigerator is not going to pay the entire amount in the next 12 months, right? In the same calendar year. So in this case, the IRS has provided certain relief wherein you can defer the gains. That means you can recognize gain as and when you receive the installment payment. Okay, and remember that installment method is reporting gain method, which is for non-merchants and for non-dealers. Okay. So this is something that they are doing, which is not in their ordinary course of business. So how do we understand how much gain or gain we will recognize based on the installment amount that we are receiving? We will calculate the gross profit. Now this is very simple. You take the sale price minus your adjusted basis. Now remember, you will have to be very careful with the terminologies that are being used here, because basis is your initial investment in the product. Adjusted basis is, that means the basis is either adjusted for appreciation or it has been adjusted for depreciation. All right. So whatever your sale price minus your adjusted basis is going to give you gross profit. And then you are going to calculate your gross profit percentage, which is nothing but the gross profit that you've calculated as your numerator and the sale price as your denominator. Once you determine your gross profit percentage, whatever cash that you collect in each calendar year on the installment sale, you will multiply that by gross profit percentage, and that much of gain you will recognize in that period. Okay. So to understand this concept better, let's look at example. Assume that a taxpayer has $400,000 in installment sale in year one, and a December 31st year one balance in the installments notes receivable is $150,000. So the installment sale was for $400,000. There is a balance that is yet to be received on this installment sale is for $150,000. So what does this mean? How much of the installment sale money that we have already received? If $150,000 is my balance on the 31st, that means I have already received $250,000. The taxpayer had $300,000 as its adjusted basis. So my adjusted basis is $300,000. My sale price is $400,000. So what is my gross profit here? Simple math, right? 400 sale price, adjusted basis of $300,000. My gross profit is $100,000. What is my gross profit percentage? $100,000 as your numerator and $400,000 as your denominator. You get a gross profit percentage of 25%. Now, in year one, your remaining balance is $150,000. Okay, so that means you have already received $250,000 of amount on your installment sale. So how much? The question is, calculate the gross profit percentage and gain recognized in year one under the installment method. So what is the installment amount that we have received in year one? We've already determined that if our ending balance is $150,000, we have already received $250,000 of installment amount. So on this amount, we will take 25% and we will recognize a gain of 62,500. Now, what do we understand from this example? Excuse me. That though our gross profit is $100,000, we are only recognizing and paying taxes on 62,500 and not on the entire $100,000 because we are able to defer our gains based on the payment that we are receiving. And again, be mindful that this is only for non-merchants in personal property and non-dealers in real estate. Okay. Now, usually installment sale has a component of interest attached to it because you have the liberty to pay over a period of time. So, you would want to charge interest on it. And there are some additional concepts. This will make more sense once I explain you section 1245 and section 1250. So once I explain that, you can come back and read this section. Okay, another transaction where there is gains are exempted and losses are disallowed is the treasury stock. So that means when a corporation is selling its own stock, repurchasing or reissuing its own stock, that transaction, it is exempt from any gain or any losses. Okay. So far we did all the transactions where either the gain were deferred or the gains were excluded, or the losses were deferred or the losses were disallowed. All right. Now we are going to move on to the next module today. And hopefully today I'll complete the next module. And by tomorrow's class, we will be done with this chapter. So let's understand this module. This will fairly come easy to everyone. A reason being is that we all understand what is assets. Few of the concepts that we are going to learn here, see few important sections that we will learn here is section 1231. We will learn section 1245. We will learn section 1250. We will learn section 291. We will learn how the netting of capital gains and losses takes place. What is the implication of the capital gains and losses at the corporate level? And what is the implications of capital gains and losses at the individual level? Okay, so I'll repeat myself. Few of the concepts that we are going to learn under this section is 4 code sections, which I want you to go back and make a note of. Usually, any code sections that is mentioned in the textbook, I would like you to make a note of it, because remember that when you are sitting for your regulation examination, which is your core paper, you cannot skip that paper, which is again will be taught by me. You will get a research simulation on that paper. Okay, so if you know how to look for the code section, or if you read the question and you can understand that which code section it pertains to, you can be rest assured that you will score full marks on that research simulations. I do take a special class on the research simulation so that, I walk you through the authoritative literature and I show you how to effectively do a research in your examination. Okay. So make note of all the code sections that we would be covering in this section, and be mindful that when we are discussing the capital section, whether it is pertaining to an individual taxpayer or whether it is pertaining to a corporate taxpayer. Remember, in my first class, I had mentioned that there are different ways a taxpayer is taxed. Individual taxpayer has progressive rates. That means the tax rate percentage increases as and when their income increases. And then there are different filing statuses. We spoke about the 5 different filing statuses. So out of which married filing jointly and qualifying widow or widower have the same tax brackets. And then the other 3 filing status has different tax brackets. So depending upon your filing status, your tax brackets also changes. Okay. All that we will learn when we come to regulation. All right. These topics that I'm starting my class with, please be mindful that these are one of the easiest topic that I have picked for you so that you can get a little bit hands-on on the subject. Remember, if you have selected TCP, that means you want an advanced knowledge on the US taxation. So there would be certain concepts which will come across as difficult if you have not attended the regulation classes. So before I move on to those sections, I will give you, certain homework which you need to do before you come for the class. All right. So moving on to the disposition of trade or business use property. Now, what is the nature of the property will be dependent upon the usage of the property. Okay. So today, let's say I buy a truck. Okay. I buy the truck. Let's say I buy a Mahindra and Mahindra truck, and I use that truck for the farm that I have. Okay. So I use it to, get all the inventories. I use it for business visits. Basically, I'm using that truck in my farmhouse. And then there is a Mahindra and Mahindra company, which is manufacturing these trucks. Okay. So now for Mahindra and Mahindra, who are manufacturing these trucks, how are you going to record these trucks on their balance sheet? It is an asset, but how do you record those trucks in their balance sheet? Because they are in the production, they are in the business of manufacturing trucks. It is an inventory for them, right? Now, when you sell an inventory, is it a capital gain for you or it's an ordinary income? So inventory is nothing, but that is not sold, right? You have an asset which is not sold. So eventually when you sell it, you are recharacterizing that. It moves out from your balance sheet and it sits on your income statement, right? So when you sell inventory, it is an ordinary income for you. But let's say if I have bought the truck, right? And I'm using this truck in my business. I'm not into the business of manufacturing trucks. So how will I record this Mahindra and Mahindra truck on my balance sheet? What kind of asset it will be for me? It is an asset for sure, but is it an ordinary asset or is it a capital asset for me? It is going to be a capital asset for me. And when I sell the truck, what kind of gain will I reap out of it? How will I characterize the gain or a loss? It will be a capital gain or loss for me. Remember, in this chapter, we have to be very mindful of the nature of the gain. Okay, first we have to understand how we are characterizing the asset, whether it's a capital assets or whether it's a non-capital asset. And then we'll understand what kind of gain or losses we are reaping, whether it's ordinary gain or losses or it's going to be capital gain or losses. Now, why it is important for us to understand the nature of the gain or losses, why it's ordinary or why it's capital? Because of two reasons. First is that when the taxation happens at the individual level, there are different tax rates for a capital gain and for a ordinary gain. Okay. So capital gains usually have preferential rates. Now, what do we understand by preferential rates? Preferential rates means that you are taxed at a lower rate on these nature of income. So capital gains are taxed at a lower rate. Also, other important thing when we want to understand the nature of the gain is the offsetting of the gain or losses. So not all the capital losses can be offset against your ordinary income. There is a limitation on how much of the losses can be offset against other nature of income. And likewise, at the corporation level, though we have a standard tax rate of 21% on all category of income, whether it's ordinary or whether it's capital, but the I would say the netting of the losses, so capital losses cannot be set off against ordinary income. So that is the reason it is very important for us to understand what is the nature of the gain. Okay, so the product or the asset will depend whether it's a capital assets or whether it's an ordinary treatment asset will basically depend upon the usage of the property. Depending upon the usage, you will characterize it as a capital asset or you will characterize it as a ordinary asset. So few examples that I would like you to understand is that copyright, literary, musical or artistic composition held by the original artist is going to be a ordinary, or it will be treated as ordinary. Whereas if you have copyrights, musical or artistic composition that has been purchased from someone else, that would be considered as a capital asset. Okay. So if A.R. Rahman today is composing any song, it is not considered as a capital asset. Okay. But if Tips Industries goes ahead and buys A.R. Rahman's song, the composition, then for Tips Industries, that becomes a capital asset. All right. Now we look at the illustration that is mentioned here. Maya, a CPA, is preparing year 1 federal income tax return for her client, Kenya Jones. Kenya's sources of income includes her self-employment business, rental property, and investment property. She also has $100,000 gain in year 1 from the sale of land, which was used in her self-employment business and was held for 2 years. Maya received the following message in a software diagnostic report when she was preparing Kenya's year 1 income tax return. Okay, issue gain on sale of the land. Now, what will be the gain on sale of the land? An amount of $100,000 was entered to override the calculation of gain or loss on the sale of the land. No date was entered. Now, why date is important here? Why do you think it is important for us to know the date of the purchase and the date of the sale? Have we all heard about short-term capital gains and long-term capital gains? I'm sure we all do some kind of trading, or we have a demat account, or we would have learned this when we were just in our intermediate and doing accounting classes, right? So date is important for us because we would want to know whether this gain is going to be a short-term gain or it is going to be a long-term gain. These dates must be provided to determine the character of the gain and how the gain is to be taxed. Remember that short-term capital gains are always taxed at ordinary rates, whereas long-term capital gains are taxed at preferential rates. No entry was made to select the type of property in box 84. Now, why type of property is important? Whether it's a business use, personal use, it's an investment or it's an inventory. Why do we need this information again? We just spoke about it, right? So depending upon the usage of the property, we can determine whether it's going to be ordinary income for us or it is going to be treated as a capital gain for us. The type of property must be provided to determine the character of the gain and how the gain is going to be taxed. So Maya should enter the date acquired and sold so that the holding period can be determined. Once the date was entered, the software application will recognize the land was held for more than 1 year. Therefore, the gain is a long-term capital gain. Maya should also select the appropriate type of property for the land sold. Because the land is being used in self-employment business, she should select use so that the software application can correctly calculate the gain as section 1231 gain to be included in section 1231 netting process. Now, what is section 1231 is something that I'm going to explain next. Okay. Two things that you have to remember in order for you to identify whether the property is a section 1231 property or not. The first thing is that the asset is used by the taxpayer in their trade or business. Okay, that's the first criteria. And the second criteria is that you have held the property for more than 12 months. So first is that you're using the property in your ordinary course of business. And the second is that you're using the property at least over a year. Okay. If you satisfy both the condition, then it is treated as a section 1231 asset. Now, we already know what is a personal asset, what is a real asset. Yes, no, maybe. We all know what is a personal asset. So if I say tools, equipments, machinery, which category are you going to post these equipments, machinery? Are they real property or they are personal property? They are not real property. Okay. I'm glad people are posting their responses in the chat window because this way I'll understand whether you actually know what is the difference between a real property and a personal property. So they are definitely business property because you are using those equipments, machinery, tools in your ordinary course of business, but they do not fall under the category of real property. Real property is your land, is your building, any structural constructions on a piece of land is treated as real property. Anything other than that is your personal property. So your tools, your furnitures, your fixtures, your machinery, they are all treated as personal property. Okay. So please be mindful that for business purposes, they are definitely business property, but they fall under the category of personal property. Okay. Don't go by the literal meaning of the word personal. So 1231 asset, as I mentioned, if you satisfy both the requirements, it is a 1231 asset. Now it can be a real property and it can be a personal property. That means if a land is being used in the ordinary trade or business and you hold the land for more than a year, it is a section 1231 property. Likewise, if you have furniture which you are using for ordinary trade or business. If you're using you know uh, this furniture for ordinary trade or business and you're using it for over a year, it is a 12 section 1231 personal property, all right? Now that we have understand how to identify section 1231 asset, now the next thing is, why do we have this code section in place? What is the benefit of this code section, or why do we need to understand this code section for tax purposes? One thing that you need all to remember is that you are studying tax planning and compliance. Any section, any concept that we study here, we are trying to identify the tax implication of that concept. Okay. So why it is important for us to know whether a property is a section 1231 property or not? The reason is that there are some favorable provisions by the Internal Revenue Service for this section. Now, what it says that if you have a property which is used in your ordinary trade or business and if you hold it for over a year, when you sell such property for a gain, the gain is treated as a capital gain. So if the gain is treated as a capital gain, what is the advantage for individuals? If a gain is a capital gain, what is the advantage for individuals? You will have preferential tax rates. You will pay less taxes compared to the ordinary income. Okay. What is the benefit for a corporation if it is a capital gain for them? See, for a corporation, everything is taxed at 21%. They don't get any preferential rates. But what could be one of the advantages for a corporation? Absolutely. Thank you, Tripti. So they can use these capital gains to offset their capital losses from the prior years. Okay. Now, another benefit of Section 1231 is that if you sell this property at a loss, then the loss is treated as an ordinary loss. Now, what is the advantage of the loss being treated as an ordinary loss? Think as a tax practitioner. If the loss is ordinary, what is the advantage for an individual? See, I have not taught this, but for individuals, they can only set off up to $3,000 of capital losses against the other bracket of income. But if the loss is ordinary, then I can set off these ordinary losses against my ordinary income. I don't have the threshold of that $3,000 of capital losses. I can deduct more losses. So my income will go down and I will have to pay less taxes. And what is the advantages for the corporation? So for a corporation, if they're selling this asset and it's a ordinary loss for them, they are not restricted now to not set off these losses against their ordinary income. Because capital losses cannot be set off against ordinary income. So because it's an ordinary loss, they can set off these losses against the ordinary income. All right. So capital gain treatment, as I mentioned, for corporations, capital gains can be offset by capital losses. And for individuals, you are taxed at a preferential rate, which can be anywhere between 0 to 20%. So remember, for individuals, you have progressive tax rates. That means as and when your income goes up, the tax rates also goes up. So likewise, for your capital gains also, depending upon your income, there is a possibility that you may not be taxed anything on the capital gain, or at a maximum, you can be taxed at a 20%. So 20% is the maximum tax rate on the capital gains. Okay. Now, this provision is very tax friendly for individuals and for corporations. But to ensure that there is no abuse of the provision, there were certain uh, other rules that were put across this provision. So we have section 1231 5-year look back rule. Okay. Section 1231 5-year look back rule, I'll just explain in a moment. Give me 2 minutes. I'll just be back. In the meantime, please read this section. Now let's understand what is section 1231 5 years look back rule. So remember, as I mentioned, that this is a tax friendly rule. And obviously, the Internal Revenue Service, the IRS, does not want this rule to be abused. So they came up with a 5 years look back rule. What they are trying to say is that in the year you have a gain on section 1231, okay, you have to look 5 years back whether you have taken any section 1231 losses. If in the past 5 years you have taken a section 1231 loss, then you need to recharacterize that gain that you have in the current year as a ordinary gain, and anything excess can be treated as a anything excess can be treated as your capital gain. Okay. So this is what you have to be mindful of. We will understand this better with an example, but whenever there is a gain in the current year, what you have to do is you have to go back and look for the past 5 years. If you have taken any section 1231 loss, if you have taken a loss, then you have to recharacterize the gain in the current year as an ordinary gain and pay ordinary taxes on it, and the remaining can be treated as capital gain. Let's say in the past 5 years, you have not taken any section 1231 gain. Manisha, what does that mean? Is I'm still explaining. I'm not done with the explanation, okay? So let's say in the last 5 years, you have not taken any section 1231 losses. Then what will be the character of the gain in the current year? So let's say you have $20,000 of gain. And in the last 5 years, you have not taken any section 1231 losses. What will be the character of the gain here? It'll be an ordinary gain or a capital gain? It will be a capital gain. Okay. Let's say I have taken $10,000 of section 1231 loss in year 3. And in the current year, I have a section 1231 gain of $20,000. So in the past 5 years, I have taken a $10,000 of section 1231 loss. So what do I do with this $20,000 of gain which I have in the current year? I will recharacterize that gain to the extent of $10,000 as my ordinary gain, and then the remaining $10,000, I'm going to treat it as capital gain. So we'll understand that better with another example that is given here. Lancaster Inc., a C corporation, purchased land that is used in its business for $100,000 in year 1. Lancaster sold the land in year 7 for $150,000. Okay. Lancaster had a prior uncaptured net section 1231 loss in year 3 for $30,000. Lancaster had no other 1231 gain or losses in year 7 and no other prior section 1231 gain or losses. Okay. So let's first understand what is the gain on the land that I have sold in year 7? My purchase price, that means my basis is $100,000 and I have sold the land for $150,000. Okay. So my gain here is $50,000. Lancaster had a prior uncaptured Section 1231 loss in year 3 for $30,000. Okay. Now, what would have been the treatment of this loss in year 3 for the corporation? What would have been the character of this loss for the corporation in year 3? Remember, I told you that a Section 1231 loss is an ordinary loss and a Section 1231 gain is a capital gain. Okay. So in year 3, they would have taken this $30,000 as ordinary loss, and they would have reduced their ordinary income with this loss, and they would have paid less taxes. Now they are selling a Section 1231 property where they are reaping a gain of $50,000. So what does IRS says? Go back and see in the past 5 years if you have taken any Section 1231 loss. If you have, then to that extent, you need to recharacterize your gain as ordinary, and the remaining will be treated as capital. So my 50,000 gain in year 7, out of that gain, how much should I recharacterize it as ordinary? In year 3, I have taken $30,000 of loss, right? So $30,000 will be treated as ordinary, and the remaining $20,000 will be treated as long-term capital gain. Okay. In this same example, if I say that in year 3, Lancaster Inc. had a loss of $70,000. So instead of $30,000, they took a Section 1231 loss of $70,000. Now, how does your answer change? What do you do with the $50,000 of Section 1231 gain that you have in the current year? The entire gain will now be treated as ordinary gain. And you will still have a certain amount left that you may need to recharacterize under the 5 years look back rule. Okay. Are we all clear on this example? Yes, no, maybe? Yes, if there is no capital, no losses in the prior year, everything is a capital gain. All right. So now that we have a fair understanding of what is Section 1231 property, we will now move on to another section, which is Section 1245. And this section is only applicable to gains. Okay. Section 1245 is a section which is on the personal property. What are personal property? Personal properties are generally depreciable personal property used in trade or business for more than 12 months. So your vehicles, your computers, machinery, equipment, tools, all these are your Section 1245 property. Okay. Now, before I give you more information about this section, this says that it is only applicable to gains. Okay. So let's understand this in a very logical way. So if you have bought a vehicle and you are using that vehicle for business purposes, okay, there is a wear and tear that is happening. So in order to record for that wear and tear, what do you usually do to the assets? We depreciate the assets, right? So we determine a life of the asset and we depreciate the asset because we are using the asset in the trade or business, and eventually there will be wear and tear, and they will have a life through which they can be used. All right. Now this depreciation that you are taking and reducing the value of the asset, where do you put this depreciation expense? Is it an actual expense or is it a phantom expense? Come on, people. I'm sure we have all done income statement and balance sheet. What I'm asking is very logical. Is it an actual expense or is it a phantom expense? Do you actually get to take a deduction on your income statement, or you're not allowed to take a deduction on your income statement? We are absolutely allowed to take a deduction. Okay? Though there is no movement of cash that is happening. Depreciation, there is no. So that's why when you do cash flow, you will have to, you factor in depreciation, amortization, and depletion, because there is no movement of cash that is happening here, but it is an actual expense. And you do get to reduce your taxable income with the depreciation, amortization, or depletion amount, right? So when you take a depreciation deduction as an expense, is it a ordinary expense for you, or is it a expense which is capital in nature? It is a ordinary expense for me. So you bought a, let's say for example, you bought a car of $10,000, which you're using it in your ordinary trader business. You have taken an accumulated depreciation of $5,000 in that car, and your adjusted basis in that car is now $5,000. So how much of ordinary expenses you have already taken on this car in the form of depreciation? You have taken up to $5,000, and you have been able to reduce your ordinary income by it. Okay. Now my adjusted basis is $5,000. Basis this, I'm going to determine whether I'm going to have a gain or loss on the sale of the car. So let's say after using the car for 5 years, you decided to sell the car for $7,000. So you bought the car for $10,000. You depreciated the car for 5,000. Your adjusted basis is 5,000. And now you are selling the car for $7,000. What is your gain or loss in this transaction? So we have a gain of $2,000. Okay. Now tell me one thing. If I would have not depreciated this vehicle, okay, I would have kept the vehicle at its cost price. Would you have any gain on this transaction? Absolutely not, right? Why are you having a gain on this transaction? Because you adjusted the basis of the property by depreciation. Okay. So you took depreciation as an ordinary expense and you reduced the value of the property. So what IRS is saying is that when you have a gain on the property, because you have adjusted the basis of the property due to depreciation, any gain that is pertaining to the reduction of the property due to depreciation should be treated as an ordinary gain. Okay. Why are they saying this? Because when you depreciated the car, you took the depreciation as an ordinary expense. When you are selling the car and you've reduced the basis, and because of the reduction of the basis, you are getting a gain, you cannot recharacterize that gain as capital. You have to treat the gain as ordinary. Okay. So that is section 1245 gain. That means if there is any, sale of the asset, which is pertaining to the accumulated depreciation, we call it recapture. You are recapturing that gain as an ordinary income under section 1245. Okay. Now, keeping the same example of the car, let's say that we bought the car for $10,000. We took a depreciation of $5,000. My adjusted basis is $5,000. But this was a vintage car. Okay. And I sold the car for $12,000. So what is the gain here? My gain is now $7,000. Okay. Now, if I would have not depreciated the property, people, again, a friendly reminder that I will miss out on your questions if you post your questions while I'm explaining the concept. Once I'm done explaining the concept, I will give you 15 minutes. Please post your questions then so that I can answer them. And also, if you post questions in between I'm explaining, it kind of distracts me. Right. So this $7,000 of gain that I have, how much is it pertaining to the depreciation that I have taken on the car? So I had depreciated the car for $5,000. So that $5,000 is the recapture of the depreciation, which will be treated as an ordinary income. And what is the gain which is over and above the cost price of the car? So I had bought the car for $10,000. I'm selling it for $12,000. So the $2,000 of gain is over and above my purchase price. So that is going to be Section 1231 gain. And what is Section 1231 gain? What is the character of that gain? It's a capital gain for me. So now you understand the logic as to why the IRS is bringing in Section 1245. They are saying that if you depreciate your property, right, you are taking it as an ordinary expense and now you're also reducing the basis of the property. So when you eventually sell the property, you will have to see whether the reduction of the basis was due to depreciation and the gain that you have is because of the depreciation that you have taken. So if that's the case, that we will call it as recapture of depreciation and it will be a Section 1245 gain, which will be ordinary in nature. And anything that is over and above the actual purchase price of the asset is going to be your Section 1231 gain, which will be capital in nature, right? So your Section 1245 is on gains only. Okay. Now, in this example, the car example that we have, we purchased the car for $10,000. We took a depreciation of $5,000. Our adjusted basis is $5,000. And now we sell the car for $3,000. So what is my gain or loss in this transaction? My adjusted basis is 5,000 and I'm selling it for 3,000. So here I have a loss of $2,000. Will Section 1245 come into picture? There is no gain in this transaction, right? So what are you trying to recapture? There you cannot recapture because we have not had any gain. So remember that Section 1245, Section 291 and Section 1250 will only come into picture when there is a gain on a transaction. So what is going to be this loss? Is it going to be an ordinary loss or is it going to be a capital loss? If this car was used in an ordinary trade or business and I held the car for more than a year, the loss that I have for $2,000, is it going to be a capital loss or it's going to be an ordinary loss? Okay, so I gave you two hints here. You are using the car in your ordinary trade or business and you held the car for more than a year. If you are satisfying both the criteria, then this is a Section 1231 property. If this is a Section 1231 property, the losses are treated as ordinary. Okay, so this $2,000 is going to be your ordinary loss. All right. Now, your recapture is usually the lesser of the gain recognized or accumulated depreciation. The easy way to remember this concept is look at the actual purchase price of the asset. If the sale price is over and above the actual purchase price, then anything that is excess of the actual purchase price is your section 1231 gain, which will be capital in nature. And anything that pertains to the depreciation of the asset will be your section 1245 gain, which will be ordinary in nature. Okay, so let's read this example. Lancaster Inc., a C corporation, owned equipment used in its business with an original cost basis of $100,000 and accumulated depreciation of $30,000. Lancaster sold the equipment after 2 years for $95,000. So first of all, what is my adjusted basis in the property? I bought it for $100,000. I have depreciated it for $30,000. So my adjusted basis is $70,000. Now, I am selling the property for $95,000. So is the sale price over and above the purchase price of the asset? The purchase price was $100,000. Your adjusted basis is $70,000, but you're selling it for $95,000, right? So you are not selling the land or the equipment over and above the original purchase price. So what is your gain in this transaction? $25,000, right? Does this $25,000 all pertain to the recapture of the depreciation? Right? This is all pertaining to the recapture of the depreciation because you took a depreciation of $30,000 and you reduce the basis of the asset to $70,000. That's the reason, even though you're selling the equipment for $95,000, you still have a gain of $25,000. Okay. So this $25,000 is going to be your section 1245 gain, and you will have to treat this as ordinary. Now, in the same example, if I change the sale price to $105,000 instead of $95,000, then how much will be my section 1245 gain and how much will be my section 1231 gain? If I change the sale price to $105,000, how much am I selling over and above the cost of the original price of the asset? So, if I change my answer to like my sale price to $105,000, $5,000 is going to be my section 1231 gain, and the $30,000 is going to be my section 1245 gain, which is nothing but the recapture of the depreciation. Everyone clear on this example? All right. We have one more example where we have multiple assets. Okay. Robert Printing Inc. sold the following assets during the year. So there is a printing press, there is a photocopier, and there is a delivery van. Are all these assets capital assets? Or I would say, are all these assets section 1245 personal assets? Right? Do we have any real asset here? We don't have any real asset because remember, section 1245 is only applicable to the personal property and not to the real property. Okay. So we have the selling price of the printing press, which is 4,000. Cost is 6,800. Accumulated depreciation is 3,200. Adjusted basis is 3,600. Okay. So here the sale price is 4,000 and my original cost of the printing press was 6,800. Am I selling it over and above my original cost of the printing press? So this gain that I have, because I adjusted the basis of the property for the depreciation, what will be this gain? This gain will be section 1245 gain, which will be ordinary. Okay, now let's look at the photocopier. The photocopier selling price is 2,600, cost is 2,500, accumulated depreciation is 500, adjusted basis is 2,000. Now, am I selling this photocopier over and above my cost price? The answer to that is yes. How much is it over and above my cost? $100. So that $100 is going to be my section 1231 gain. And the remaining $500 will be my section 1245 gain. Okay. Are you all with me till the photocopier? Everyone understands? All right. Let's look at the delivery van. The delivery van selling price is 500. Cost is 15,000. Accumulated depreciation is 13,000 and adjusted basis is 2,000. So your adjusted basis is 2,000 and your selling price is 500. Will section 1245 come into picture for delivery van? Why it will not come into picture? Because it's a loss. Now this loss that you have for $1,500, is it a section 1231 loss? It is a section 1231 loss, assuming that all these assets are used into trade or business and they are held for more than a year. So in this example, you have a $400 of section 1245 gain. In the photocopier, you have $500 of section 1245 gain and $100 of section 1231 gain. And you have a section 1231 loss of $1,500. Now, the next very important thing that we need to understand is that we need to net the section 1231 gains with section 1231 losses. Okay. So how much is my section 1231 gain? It is $100. How much is my section 1231 loss? It is $1,500. So what is my net section 1231 loss? It is $1,400. What is my section 1245 gain? 400 for printing press and $500 for the copywriter. So of this, $900 is going to be my section 1245, which will be treated as an ordinary. Okay. So the net section 1231 loss of $1,400 is treated as ordinary loss. So basically, you are not grouping everything together. You are keeping it separate because for tax purposes, there are different provisions that you have to keep in mind. All right. The next that we will move on is section 1250. These concepts are not difficult. Okay. Remember that I told you that I have started with the most easiest topic. You will have to go back and read a couple of times the content for it to make sense because US taxation is new for everyone. So in order to get a grip, you will have to read a couple of times. The next we move on to is the section 1250, which is on the real property. And again, remember that this is only applicable on gains. It is not applicable on losses. What is a real property? It can be a warehouse or it can be an office building, but not land. Okay. Do you usually depreciate land? Is there any depreciation that happens on land? right? So remember, these sections are pertaining to the recapture of the depreciation. So obviously land does not fall into that category because you don't depreciate the land. So what will you recapture? All right. Now, section 1250 for the corporation was applicable for the properties, the real properties that were acquired before 1987. What do I mean by that is, there could be different depreciation method for tax purposes, and there could be different depreciation method for book purposes. So now, you have to depreciate the real property on a straight line method. But earlier, there were other, accelerated depreciation methods which was available. So the recapture of the section 1250 was on the excess depreciation that you took over the straight line method. But after 1987, they said that we'll only follow one method, which is straight line method. So section 1250 recapture was no longer applicable for the corporations. It is still applicable for the individuals, which I will explain in a bit. So what is applicable for the C corporations now? What is applicable for the C corporation now is section 291. So what does section 291 says that if you are selling a property at a gain, okay, you are going to look at the realized gain and you are going to look at the depreciation recapture amount, and 20% of the lesser of the recognized gain or the accumulated straight line depreciation, whichever is lesser, that 20% of the amount, you are going to recharacterize that as section 1250 and treat that as ordinary. Okay. Note that section 1231 recapture only applies to C corporation and not other type of businesses. Okay. Please make a note of it. It is very, very important point. That section 291 is only applicable to C corporations and not other types of businesses. So if you are a proprietorship or, if you're operating as an S corporation, then this might not be applicable for you. So let's look at this example here. Lancaster Inc. C corporation owned a building used in business with an original cost of $100,000 and a straight line depreciation, accumulated depreciation of $15,000. So your cost is $100,000. You've taken a accumulated depreciation of $15,000. What is your adjusted basis in the building? Adjusted basis, I've been reiterating this again and again. That means you have adjusted the basis for either appreciation or depreciation, right? Your adjusted basis after you've taken the depreciation is $85,000. Lancaster sold the building for $95,000, right? So here, the sale price, is it over and above the cost of the original price of the building? No, right? So the entire gain of $10,000 is because of the depreciation that you had taken on the building. But remember, here section 1250 will not be applicable because you had taken only straight line depreciation. You had not taken any other form of depreciation. But section 291 will come into picture. So section 291 says that you have to take 20% of the gain as ordinary. You have to recharacterize that gain ordinary, which is the lesser of the recognized gain or the accumulated straight line depreciation. So here our gain is $10,000 and our accumulated depreciation is $15,000. So which is lesser here? Gain is lesser or the accumulated depreciation is lesser? Obviously, the gain is lesser, right? So we will take 20% of this $10,000. So 20% of the $10,000 is $2,000. So $2,000 will be treated as section 291 and will be treated as ordinary. The remaining $8,000 will be treated as Section 1231 gain. All right. Now, in the same example, if I change the sale price to $105,000, what will be your Section 1231 gain and what will be your Section 291 depreciation recapture amount, which will be taxed as ordinary? Please be mindful before you put your answers. Okay, this is not Section 1245. This is Section 291. So if I change the sale price of the building to $105,000 instead of $95,000. And I will highlight this section. If I change the sale price of the building to $105,000, what is going to be your ordinary gain and what is going to be your Section 1231 gain? Is that so difficult? So first of all, tell me what is going to be your Section 291. So Section 291 means that you have to take the 20% of the recognized gain or accumulated straight line depreciation. So here, your accumulated depreciation is $15,000, but your actual gain is, so your basis is $85,000 and your sale price is $105,000. So your gain here is $20,000, right? So your gain is over and above the accumulated depreciation. So you will take 20% of the accumulated depreciation, which is going to be $3,000. So of the $20,000 of gain, if $3,000 is Section 291, what is the remaining gain? So $20,000 is the gain. You already identified that $3,000 is your Section 291 gain, which is ordinary. Obviously, the remaining is going to be your Section 1231 gain, which will be capital in nature. Okay. Do we all understand this concept now? How is Section 291 applicable? Okay. Now we move on to Section 1250 recapture for individuals. And here you have to break this concept into parts in order for you to arrive at the correct answer. Okay. Now Section 1250 is still applicable for individuals. And remember that Section 1250 will only come into picture if you are selling the property at a gain. Okay. So what is the first step? The first step is that if you are selling multiple assets, you will characterize all the gain in under Section 1231. Obviously, if you are using it into the ordinary trade or business, you will net everything under Section 1231 and then determine whether you have a overall gain or you have a overall loss. If you have a overall loss, then there's nothing to do. Everything is treated as ordinary and you're done and dusted. But if you have a overall Section 1231 gain, then the next step that you do is you characterize that gain as recapture Section 1250 gain to the extent of the recognized gain on the sale or accumulated depreciation taken on the asset. Okay. And there is also a look back rule. Remember the 5 years look back rule? The 5 years look back rule converts the uncaptured Section 1231 gain to ordinary income first and then to regular Section 1231 gain. Why do we have so many things when it comes to individual? The reason being is that for individuals, ordinary gains, ordinary gain is taxed at a higher rate. Capital gains are taxed at a preferential rate, and Section 1250 gain is taxed at 25%. So there are different tax bracket for each kind of gain. Okay, ordinary gain has a different tax rate. Section 1250 gain has a different tax rate, and your capital gains, that is Section 1231 gain, will have a preferential rate. So first step is you are netting Section 1231 gains with losses. If you have loss, you are good. If you have gain, then to the extent you have gain, you will recognize that as 1250 gain depending upon the amount. Then off that Section 1250 gain, you will then look back 5 years and see if you have taken any Section 1231 losses. Of that losses, you will have to recharacterize that Section 1250 gain as ordinary. And if you still have anything remaining, then that will be taxed at 25%. Okay. So to understand that better, we'll do these two examples, which will make the concept very clear. So let's look at example number 5. Lancaster Company is a sole proprietorship and is reported on Schedule C of the taxpayer's individual tax return. Lancaster owned a building with an original cost of $100,000 and straight line depreciation of $15,000, resulting in a tax basis of $85,000. Lancaster sold the building for $95,000. There was no other sale of property during the tax year and no other Section 1231 losses. Okay. So here you have a building which is worth $100,000. You've taken an accumulated depreciation of $15,000. Your adjusted basis is $85,000. You have sold the building for $95,000. Okay. So are you selling the building over and above the actual cost price of the building? Your purchase price was $100,000. You're selling it for $95,000. You still have a gain on this transaction for $10,000 because you depreciated the building for $15,000, right? Now, what does it say? That in this section that we said that first you have to net Section 1231 gains with Section 1231 losses. Do we have any Section 1231 gain and losses in this example? They have clearly mentioned that there is no prior Section 1231 losses. Okay. So in this case, the $10,000 is your Section 1250 gain. Now, the second thing they're asking is to look back 5 years and recharacterize that 5 years losses into ordinary. In this example, do we have any prior year Section 1231 losses? We don't have any Section 1231 losses. So this $10,000 of gain that we have is my Section 1250 gain, and this will be taxed at 25%. The amount, the gain realized on the sale of the transaction is $10,000. The gain is a Section 1231 gain, and because there are no other properties sold during the year, the overall net Section 1231 gain is $10,000. The amount taxed at 25% Section 1230 gain rate will be $10,000, which is the lesser of the recognized gain or the straight line depreciation of $15,000. No portion of the gain will be taxed at a preferential rate. Now, in the same example, if I change the sale price of the building to $105,000 and everything else is remaining the same, then what will be my Section 1250 gain and what will be my Section 1231 gain? If I simply change the sale price of the building and all the facts remains the same. The sale price is $105,000 now. So for individuals, if you see, the concept is more or less like what we had done for section 1245 personal property. So if I sell the building for $105,000, am I selling it over and above my purchase price of the original building? The answer to that is yes. How much am I selling over and above my purchase price? By $5,000. So that $5,000 is going to be my section 1231 gain, which will be taxed at a preferential rate between 0 to 20%. Now, I have an adjusted basis of $15,000, right? So the remaining $15,000 of gain is pertaining to the depreciation that I had taken because that helped me reduce the basis of the property. Now this $15,000 will be treated as my section 1250 gain. And how much tax I'll pay at an individual level? I will pay a tax of 25% on that gain. Okay, what does it say? The lesser of the accumulated depreciation or the gain recognized. If I simply change the sale price of the building to $105,000, my gain that I will recognize is 20,000 and my accumulated depreciation is 15,000. So which is lesser here? Obviously, the depreciation amount is lesser than the gain that I have recognized. An easy way to remember is always look at the initial purchase price of the building and compare it with the sale price, because that's how you're going to identify what is section 1231 and what is going to be section 1250. Now, this example is a little bit complex. So let's again break the concept into different parts, okay? Chandra Corp, a Schedule C sole proprietorship, sold the following business use assets during the year. So there's a warehouse, there is a land. Is this a section 1245 property or a section 1250 property? Is it a real property or is it a personal property? Warehouse is a real property. Land is a real property. So you'll also have to understand which sections applies to which kind of property. Section 1245 is for personal property and section 1250 is for the real property. Okay. So here the sale price of the warehouse is $110,000. Cost is $95,000. Accumulated depreciation is $20,000. Adjusted basis is $75,000. Okay. Now my initial cost is $95,000 and I'm selling it for $110,000. Is my sale price over and above my cost price? How much am I selling it over and above my cost price? $15,000 is what I'm selling as over and above my cost price. What is the remaining gain pertaining to? I had taken $20,000 of depreciation, right? So that $20,000 of gain that I have is basically of the adjusted basis due to depreciation. So that will become my section 1250 gain. And then you see land. Land, obviously we don't depreciate. So land had a sale price of $50,000. Cost was $40,000. There's no depreciation to it. So what is the gain on the land? I bought it for 40. I sold it for 50. So my gain is $10,000 here. And what is this gain? It is section 1231 gain. Okay. So what they are saying is the first step that they are saying here is that you net all the gain as if there is any section 1250 property at a gain. The gain is characterized as section 1231 gain and netted against another section 1231 gain and losses. So here, though we have $20,000 as section 1245, the first step that we are going to do is we are going to consider everything as section 1231 gain. So what is our total gain here? On warehouse, we had $35,000 of gain. On land, we had $10,000 of gain. So after netting all the gains, we have we have a gain of $45,000, which we are treating as section 1231 gain. Okay. Now what they are saying is, after you have done that, after you've done all the losses, if the individual taxpayer has an overall net section 1231 gain for the year, the gain is characterized as uncaptured section 1231 gain to the extent the recognized gain on the sale of the property or accumulated depreciation. So here on the warehouse, we have the gain that we have realized is $35,000 and accumulated depreciation is $20,000. So what is my section 1250 gain here? We've already identified that, right? Which is lesser, the gain or the accumulated depreciation? So obviously $20,000 accumulated depreciation is lesser. So this $20,000, I am going to reduce it from my $45,000 gain. So this $20,000 is now going to be my section 1250 gain. What they are saying next here, after you have done that, the 5-year look back converts uncaptured section 1231 gain to ordinary income first and then regular net section 1231 gain. Any section 1250 gain remaining after 5 years look back is taxed at 25%. Now, after you have identified what is your section 1250, you are not now going to see if they had taken any ordinary losses in the prior year. So the company had section 1231 loss in the prior year for $15,000. Okay. So what are you going to do with this $15,000 of the section 1250 gain that you have for $20,000? You are going to treat $15,000 as section 1231 gain, right? So you have to offset this $20,000 and by $15,000 of loss that you have taken. Now this $15,000 ordinary loss was helped you to reduce your ordinary income, right? Which was taxed at the highest rate. Now if you have to recharacterize this $15,000, the character of the income will be ordinary or capital. What does the 5-year look back rule does? It recharacterize the capital gain to ordinary income, ordinary gain, right? So this $15,000 will now be treated as ordinary, and then the remaining $5,000 will be your section 1250. So we have a total gain of $45,000, right? Now because of the rules, we have characterized these gains, or we have bucketed this gain into three buckets. The first bucket is your section 1231 loss, the 5-year look back rule for 15,000. So out of $45,000, 15,000 will be taxed at ordinary tax rate. Okay. How much of the gain is left? 30,000. Out of that 30,000, 5,000 is your section 1250 gain. So how much tax rate will be paid on this $5,000? On this $5,000, you are going to pay a tax rate of 25%. So out of $45,000, 15,000 is ordinary, 5,000 is section 1250. What is the remaining gain that is left? The remaining gain that is left is $25,000. So this $25,000 will be taxed at a preferential rate, which can be anywhere between 0 to 20%. Okay. Are we all clear? So in order to get a hold on this example, you will have to break the calculation into pieces. First, calculate the gain, then identify what is you do you have a overall section 1231 gain or you have a overall section 1231 loss. If you have a loss, then there is nothing needed. If you have a gain, then of this gain, you will have to identify which is how much is your section 1250 gain. Once you identify your section 1250 gain, you will have to go back and see if you have any 5-year look back 1231 loss. Of that loss, you will have to recharacterize certain gain as ordinary and the remaining can be treated as capital. Okay. Section 1231 gain is $25,000 is section 1231 gain, which will be taxed at preferential rate. All right. So this is the summary. How you are going to summarize this. So, like if you see there is a table also that is given. So how do you do what is a personal property? What is a real property? What are the recapture steps? So this will come very handy when you are reading the content and when you're doing your calculations. These are the flowcharts. Pass keys are also important because they help you to get a better grip on the information. So here, if you see section 1245 depreciation recapture on personal property, 100% of lesser of the gain or accumulated depreciation. Section 291 is the recapture on real property, 20% or lesser of gain or accumulated depreciation. Section 1231, to the extent of uncaptured section 1231 losses in the previous 5 years. And then regular section 1231 gain for individual taxpayer. Right? Capital gains remaining, if you don't have any 5 years look back, then everything is your capital gain. Individuals taxpayers, again, they have given the tax rates. For corporate tax rates, the tax rate is a standard of 21%. Now going back to the same example, okay, if they had not given this section, if they had mentioned that the company had no previous section 1231 losses, then what would have been your section 1250 gain and what would have been your section 1231 gains? And what would be the tax rates on these gains? If this was not given, if let's say the company did not have any look back, 5 years look back. So if there was no 5 years look back, that means of your section 1250 gain of $20,000, you don't need to recharacterize anything. Okay. So everything will be a section 1250 gain. So you would pay 20 on the $20,000, you will pay 25% tax. And on the remaining $25,000, since it's a section 1231 gain, it's a capital gain, you will have preferential rates, which will be taxed anywhere between 0 to 20%. Okay. Now in the same example, if I change the warehouse sale price to $85,000. If in the same example, I change the warehouse sale price to $85,000, then what is your section 1250 gain? Assume that this is not there. There is no recapture. If I simply change the warehouse sale price to $85,000. So if my warehouse sale price is $85,000 and my cost is 95 and my adjusted basis is 75. What will be the gain that I will have on the transaction? $10,000, right? Now this $10,000 will be my section 1231 gain or my section 1250 gain. Why are we saying that it is going to be a section 1231 gain? Let's assume that there is no look back of 15,000. Why are we saying that the $10,000 is going to be my section 1231 on the warehouse? So what's the first step? The first step is to consider all the gain as section 1231. So if I simply change the warehouse sale price to $85,000, my gain here will be 10,000 for the warehouse and 10,000 for the land. So my total gain will be $20,000. The next step is, because I have a overall net gain, I will now recharacterize certain gain as section 1250, right? So how much will be my section 1250 gain? If you see, my cost is 95 and I'm selling it for 85. So am I selling it over and above the cost? The answer to that is no, right? So the entire gain that I have is because of the depreciation that I have taken on the property. So what will be my character of that gain? The $10,000 will be my section 1250 gain. All right. And if I don't have any look back rule, then of the $20,000, 10,000 will be my section 1250 gain, which will be taxed at 25%, and 10,000 will be my section 1231 gain, which will be taxed at a preferential rate. Okay. Now let's say if I keep the same example and I also say that there is a section 1231 loss in the previous year for $15,000. What will happen now? If my overall gain is $20,000, 10,000 is my section 1250 gain, and I also have a look back section 5, section 1231 loss of $15,000. Now what happens to the gain? Come on, people. So I will not have any section 1250 gain, right? Because I have to recharacterize that entire gain to ordinary. Okay. So will it be $10,000 of ordinary or will it be $15,000 of ordinary? What does the 5-year look back rule say? So you will have to look back when a taxpayer has net section 1231 gain for the year. The taxpayer must first look back to see if there was any section 1231 losses, right? So here, even though we have $10,000 of section 1250 gain, we will, convert that into section 1231 loss and treat it as ordinary. And also we will treat another 5,000 from the section 1231 gain as ordinary. So 15,000 will be ordinary and 5,000 will be taxed at the preferential rate. Okay. So we'll start with the related party transaction in the next class. So we will wrap up tomorrow. I have not given any break to you all. My sincere apologies. Please remind me from the next time if you want a break. And now we will keep the forum open for any questions that you may have. I do have to do some questions on this topic, but I will take your questions first and then we will move on. Go ahead, Yash, whatever question you have. I did see some of you putting queries in the chat window while I was explaining the concept. So, if I have missed, I'm sure I've missed answering those. So please put those questions again so that I can answer you. Okay, Yash, when you have a loss, you cannot have a gain on the transaction even if you have received a boot, right? You recognize gain when you receive a boot when you are in a gain situation. If you have a loss, even if you are receiving cash, you will not have to recognize any gain, right? Because the rule says the lesser of the realized gain or the boot received. So where is the gain here? All right, so if people have no other questions, I'm not going to waste time and 15 minutes. We will do certain questions on the concept that we had covered in the last class and today's class. Okay. So let's read at this question. In December year 10, Davis, a single taxpayer, purchased a new residence for $200,000. Davis lived in that new residence continuously from year 10 until selling the new residence in July 17 for $445,000. What amount of gain is recognized from the sale of residence on Davis year 17's tax return? So what is the filing status of the taxpayer? People, if you're not going to participate, I'll not do these questions because I'm not doing these questions because I have to write my examination, right? It is for your benefit. So if you are a single taxpayer, what is the exclusion amount that is available for you for the sale of the property? It is $250,000. Now, in order for me to get the exclusion, I have to satisfy two requirements. I have to use the property for 2 years from 5 years from the date of sale, and I have to own the property for 2 years. So do I satisfy both the requirements? Davis is living in that new residence for continuously 10 years and he's also owning the property. So I satisfy both the requirement. My purchase price is $200,000. My sale price is $455,000. So I have an overall gain of $255,000, right? So I can exclude up to $250,000. So I will recognize a gain of $5,000 here. Okay. Let's look at question number 2. Decker, a 62 years old individual, sold his principal residence for the net amount of $500,000 after all selling expenses. Decker bought this house 15 years ago and occupied it until it was sold. The house had a cost of $200,000. Within 6 months, Decker purchased a new house for $600,000. What amount of gain should Decker recognize from the sale of the residence? Again, you have to see what is the filing status of the taxpayer and has he satisfied both the conditions, and if yes, then how much of the gain can be excluded and how much he has to pay taxes. See, purchase of the new house has nothing to do with the transaction that has originally happened on the old house, okay? That this information is there just to confuse you. So the cost of the house was $200,000. He is selling it for $500,000. There's a gain that is for $300,000. If he satisfied both the criteria, he can exclude up to 250. So $50,000 is the gain that he has to recognize. Okay, so B is the correct answer here. Okay, let's see the third question. In the current year, Axis sold land with a basis of $30,000 to. This is not a like-kind exchange. Why this is not treated? Why would this be treated as a like-kind exchange? With whom is he trading the house? He's selling the house. He's not trading the house. These are two different transactions. Okay. Can I move on, Yash? He's not trading the house. He's selling the house. Even if it is specifically mentioned, right? He's selling the house and he's buying a new house. How can it be a like-kind exchange? When it is a like-kind exchange, when you are exchanging the property, these are two separate transactions. The language is very clear on the question. Okay, so let's read the third question. In the current year, Access sold land with a basis of $80,000 to Yarrow for $100,000. Yarrow paid $25,000 down and agreed to pay $15,000 per year plus interest for the next 5 years, beginning in the second year. Under the installment method, what gain should Access include in the gross income for the year of sale? So this is a question on the installment sale. So first of all, what is my gross profit on the transaction? My basis is 80 and I'm selling it for $100,000. My gross profit is $20,000. Second is, what is my gross profit percentage? Which is my gross profit as my numerator and my sale price as my denominator. Okay. So 20,000 divided by $100,000, my gross profit is 20%. So Yarrow paid $25,000 down and agreed to pay the remaining $15,000 per year plus interest in the next 5 years. So how much is he getting in the first year? So what is my income that I will pick up in the first year? How many of us are saying D? So $25,000 into 20%, which is going to be $5,000. So this is my gross profit. My gross profit percentage is 20%. I have collected $25,000. So the income that I will pick up is going to be $5,000. Okay. Capital assets includes which of the following items? Fixtures used in a retail store, trade account receivable, real property used to store business assets, land held for personal use. Okay, looks like most of us are going with D. So D, assets held for personal use are capital assets. Okay. The sale of which of the following type of business property should be treated as Section 1231 property? Inventory held for resale, machinery held for 6 months, cattle held for 6 months, and land held for 18 months. Okay, remember that in order for a property to be Section 1231, you will have to satisfy two requirements. One, that you are using the property in your trade or business and you hold the property for over 12 months. Okay, so looks like most of us have got it right. So land held for 12, 18 months because all the other options are not correct. Okay. Next question. A taxpayer purchased a forklift for use in the taxpayer business for $20,000 on January 1 of the current year. The taxpayer sold the forklift for $22,000 on January 1st of the current year. Sorry, June 1st of the current year. What is taxpayer section 1231 gain as a result of the sale? So purchased is $20,000 in the current year. And then he sold it for $22,000 on June 1 of the current year. Okay, excellent. So the answer to that is 0 because it does not satisfy the section 1231 rules, right? Because we did not hold the property for more than 1 year. Excellent, people. Great going. With that, we have done the questions on the topics that I covered in the last two classes. So tomorrow we are going to do related party transactions, which is again fairly easy. And we will have time to start another topic. I will let you know which topic I'm going to start tomorrow. So we will be done with chapter 4. And I'll let you know which chapter we are going to start again tomorrow. I'll pick up a relatively easy topic and then we will move on to the difficult topics. Manisha, I'm not sure how many classes we are going to have depending upon how fast we are able to cover the syllabus. Please be flexible because the classes usually gets extended to what it is originally scheduled. And also because you all had requested me to reduce my class by 30 minutes because there are far classes happening. So obviously the scheduled classes will spill over for a couple of more weeks. All right. Last call. Any other question? Are we all good for the concepts that we have understood so far? All right, then if no questions, then we will wrap up the section today. And we will speak tomorrow again at 9 p.m. And, we will be covering the entire section, chapter 4, and we'll start with a new topic tomorrow. Thank you so much, everyone. Have a nice Saturday. Let's again regroup tomorrow at 9 a.m. Bye, everyone.